Legendary investor Howard Marks is calling for a flat decade. This is really, really bad. And as of his recent interview, he said when you buy the S&P 500 at a 23 PE, your 10-year annualized return has always fallen between +2 and -2% in every case. And he mainly alluded to this chart of the S&P 500's forward PE ratios relative to the 10-year return you got from whatever PE ratio the S&P is trading at. Right now, we're trading between 22 to 23 times earnings, and if history repeats itself, the return of the S&P 500 over the next 10 years is going to be 0%. And this is not something that hasn't happened before. We had many periods of 0% return, including 52 years, 26 years, and very recently from 2000 to 2013, we had 0% returns for about 13 years. And Howard Marks is not alone. There's many other investors calling for a flat decade, maybe something like what happened in Japan, where it took Japan 26 years to recover back to break even from the Nikkei's 1997 high. But I personally disagree with Howard Marks. I disagree with the comments that we will have a flat decade. I'm going to show you the math behind it. I'm going to give you my opinion on what will likely be the average return over the next 10 years and let you know why I disagree in general. Now, I believe a big mistake that a lot of investors are making is they're looking at the S&P 500, they say, oh, we're up so much, therefore we have to have a flat period. But if you look at the S&P 500 outside the Mag 7, so the Mag 7 is the blue line, the 493 stocks is the green line at the bottom. If you look at the green line, it has pretty much done nothing. We're pretty much flat, guys, since 2022. So we've been flat for 3 years because a lot of those companies were overvalued and they're catching up to their overvaluation. But most of the growth since 2020 was driven by the Magnificent Seven. The Magnificent Seven make up 31% of the S&P 500, and people believe that's too much concentration and it's risky. And I agree it's risky, but I think it's also happening for a reason. One reason is if you compare the quarterly profit margins of the Magnificent Seven in the green versus the S&P without the Magnificent Seven in the red, they don't even come close. The red, which is the 493 stocks, their profit margin is 12%. The Mag 7, it's about 28%. Absolutely crazy. If you compare the revenue growth rate of the Mag 7 versus the 493 stocks, the Mag 7 are growing about 16 to 17% on average. The remaining stocks are growing like 3 or 4% on average. So if you look at the total S&P 500, you believe we're likely going to have a flat decade. You see the overvaluation. But if you compare the internals of the S&P 500 and what has driven the performance, which is the Mag 7, the Mag 7 are growing and they are much more profitable than the remaining stocks. And they're not as expensive as you would believe because the Mag 7 in red, they're trading at 28 times forward earnings, nothing too crazy, pretty much where it was in 2020, 2021. The other stocks, ex-Magnificent 7, they're trading at 20 times earnings despite growing revenues 3 or 4% with very low margins, which is why Howard Marks has argued that he believes the Mag 7 are not too expensive and he believes the 493 stocks are actually more expensive. But I think that would give us a better picture of why the S&P 500 has had such a performance, on why it's trading at such a multiple, and most of it is not due to the Mag 7 being at bubble valuations because they're still growing and they have good margins, but I think it's due to the other 493 stocks that are barely growing 3% in revenues, yet they're still trading at 20 times earnings, like Procter & Gamble and Costco and many of those overvalued stocks. But another reason why I don't believe we're going to have a flat decade is if you look at the S&P 500, it has a very close correlation to the M2 money supply. Once the M2 money supply expands, the S&P goes up. Once it starts contracting, we had the 2022 crash. Once it starts going up, we expand again. It's a very close correlation, guys. Once it goes down, the S&P goes down. It's a very close correlation. And over the long term, with all the debt that we have and all the, a lot of central banks are going to have to keep easing for a very long time. I believe M2 money supply is going to keep increasing over the long term. And that's going to be really bullish for the S&P 500 and the Magnificent 7 specifically. Another one is the Fed balance sheet versus the S&P 500, you can see how whenever it expands, the S&P expands. Once it contracts, the S&P goes down, then it goes up, the S&P goes up, it goes down, the S&P goes down. It's a beautiful correlation. And if you look at all the debt in the world and you think of what will likely happen over the next 10, 15 years, I would see potentially much more easing than tightening. And all of those things are really bullish for the S&P 500. Now, in terms of my target on the S&P, I'm using the 2025 estimate of 270 for earnings per share on the S&P 500. I put in the 270 over here for the next 10 years, and I put in 9.5% of earnings per share growth over the next 10 years. The average earnings per share growth over the last 10 years was 9.5%. Very recently, it has been about 15%. I'm not sure if this is sustainable because a lot of it was driven by the COVID stimulus and the stimulus check and a lot of money that was pumped into the system in 2021. And I don't believe this is going to repeat itself over the next 5 to 10 years unless we have some kind of a crisis or something major happens. So I would be much more comfortable using 9.5% of earnings per share growth rate. Now, if I use 9.5% and we look at the S&P's multiple, it's about 22 times. The average has been around 16 times, but I'm using 3 case scenarios for my model. I'm using 18 times, which I believe is fair. I'm using 20 times, and I'm also using 23 times. And this is my estimate on the S&P 500. If it trades at 18 times 10 years from now, the average annual return would be 6.91%, including a 1.15 dividend. So 20 times earnings estimate would include a 7.76% annual return, including dividends. 23 times earnings, which I believe is the best case scenario, that would take us to 9.3% average annual return for the S&P 500 over the next 10 years. So I disagree that the S&P will be flat over the next 10 years, but I'm also not seeing a 15%, 20% annual return as the new normal for the next 10 years. I think some of that was a little bit too extended, and some of it was due to the stimulus checks and COVID and all of those money that was pumped in the system. That's unlikely to repeat itself over the next, I would say, 5 to 10 years. So if we're using all those estimates, which I believe they're fair, I see about a 7-8% annual return, which is the long-term average of the S&P 500. You know, a lot of newer investors believe that 15-20% a year is the new normal, but that's not true. The average return is 8%, 8 to 10%, 11%. It's not 25 and 30% on the S&P 500. So again, I don't believe we're going to have a flat decade, but I'm not seeing the returns that we saw over the last 10 years repeat themselves again over the next 10 years. And that was my opinion on the S&P 500 and Howard Marks' recent interview. You could watch it and look it up yourself. So I hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.